Welcome to Chapter 6, dear students. We have done the heavy lifting with regard to stocks. We've discussed many of the characteristics of stocks in Chapter 3, then some valuation techniques of just a few of the many available in Chapter 4, and then have taken a look at the financial statements and ratio analysis that we did in Chapter 5. Now it's time for a little silliness, but not a whole lot of silliness. That's the next chapter in chapter 7. But chapter 6 is market efficiency theory, one of the three major ways of analyzing stocks. We've done fundamental analysis. We'll take a look at market efficiency theory today. And then in chapter 7, look at the third major analysis technique called technical analysis. And I like to call this chapter, Who Can Beat the Market? Because as we're going to see, the market efficiency theorists don't believe that anybody can beat the market. Except there are people who have over decades. How do you figure? I don't know. Anyway, let's get started with a few quotes. From Sir Isaac Newton, he of gravity and the apple and planetary motion fame. I can calculate the movement of the stars, but not the madness of men. He knew where from he spoke, dear students, because he got caught up in one of the financial peccadillos of the time, the South Sea Company, and lost. Well, we don't really know how much he lost. We knew he invested a whole bunch. We don't know how much he actually got out before the thing fell apart. Technology changes. Look it up. South Sea. Just type in Isaac Newton, South Sea bubble or whatever, and you'll read all about it. The investor's chief problem, and even his worst enemy, is likely to be himself. Before all this psychology came out, all this study of psychology and investing, dear old Ben knew it all. He knew that we are our own worst enemy when we begin the process of investing. Unless we arm ourselves with good information and good techniques and a willingness to not panic when the markets fall. Slide number 2. The efficient market hypothesis is a hypothesis that deals with a market in which securities reflect all possible information quickly and accurately. If there are large numbers of knowledgeable investors who react quickly to new information, then security prices will adjust quickly and accurately. Now, what's an efficient market? New York Stock Exchange, NASDAQ, Frankfurt Exchange in Germany, and the Japanese Exchange, London. Places where there are millions of buyers and sellers all competing with one another. An inefficient market would be one where you got it, only a few sellers, lots of buyers, or vice versa. The random walk hypothesis is the theory that stock price movements are unpredictable. And you know what? They're right. In the short term. Yes, we've seen that the short-term movements are maddeningly unpredictable. But in long term, no, they haven't been. As the global economy has expanded, as technology has made our lives so much easier, and yet at the same time crazy. No, the stock market has done very well over time, but we have to put up with the volatility, and we certainly hope that the future economically is bright because we want everyone to have clean water and healthy food and clothes and shelter and diapers and cell phones and internet access and all the things that we just take for granted, because failure is not an option. And for the definitive discussion of efficient market theorists, why not read the book A Random Walk Down Wall Street by one of the professors who was involved in developing the theories back in the 1970s, Burton Malkiel. A Random Walk Down Wall Street is one of the two excellent books you should start with. That and One Up on Wall Street. I actually think One Up on Wall Street's a little better to start with because it's a little easier to read. Not that much easier to read, and they're both very witty, both very personable, great down to earth writers. Read both books; they're both awesome. Slide number 3. Now, in the 1970s, the physicists were coming up with just unbelievable theories that people just couldn't imagine, and so the market theorists kind of stole from them. They had the weak attraction and the strong attraction and the gluons that were holding the quarks together, and so the that's the physicist, and so the market theorists kind of grabbed from that, and they created the weak, semi-strong, and the strong hypotheses. So the weak efficiency hypothesis says that past data on stock prices are of no use in predicting futures, in predicting future prices. However, stock prices do tend to demonstrate momentum. Stock prices tend to rise more often than they fall. We've seen that. And they tend to move far higher than is usually justified. That's called a bubble or a mania. Or far longer than is usually warranted, a crash or a panic. And Sir John Maynard Keynes was the economist who helped the world, the West actually, get out of the Great Depression in the 1930s. And this was fast forward to the 1950s, when the stock market went in two directions, up and was way overvalued. And I'm not exactly sure all the details of the encounter, but supposedly some savvy traders had bet against the market. They had done what is called shorting, and we'll discuss that later on in the semester. Don't do it, it's dangerous, but hey. They were hoping the market would go down, and they kept complaining, and they complained to the famed economist, Sir John Maynard Keynes, that the market is irrational. This is ridiculous. These prices are way too high. And he supposedly quipped, the market can stay irrational longer than you can stay solvent. And it's true. It's absolutely true. I have a good friend who was absolutely sure that the housing market was going to implode. This was 2005 and 6, and he was right. He was just 2 years, 3 years ahead of his time, and he got hammered. If this theory is true, then technical analysis is useless. And I kind of think it is, but we'll cover technical analysis in the next chapter, especially in the short term. The next hypothesis is called the semi-strong efficiency hypothesis. Isn't that wonderful? Semi-strong. Abnormally large profits cannot be consistently earned using publicly available information. In other words, no amount of analysis that you do to determine the future price of a stock will help you beat the market. Okay, in other words, they're saying nobody can do it, so don't even bother. But there are many, many investors who have done that, have beaten the market over statistically significant periods of time. And we're going to look at some of them later when we look at all stars of investing. So the theory has a problem, right? They're saying that nobody can do it. And so what does the theory say about these investors? Oh, they're just lucky. Okay. Well, there's a apocryphal tale of a golfer, and it's attributed to many different golfers, who did really, really, really well, beat all the other golfers, and the reporter said, boy, you were really lucky out there today. And he supposedly shot back, you're absolutely right. I was really lucky. And the funny thing is, the more I practice, the luckier I get. Yeah. Is it luck? Well, in some cases, it might be in the short term, but not in the long term, dear students. No. If this is true, then both technical analysis in the next chapter and the fundamental analysis, which we covered in the previous 2 chapters, are useless. In other words, they're saying, don't bother. It's not going to help. They're big advocates of index funds, as we'll see. Slide number 6. No, 5. The strong efficiency hypothesis. No information, public or private, allows investors to earn abnormally large profits consistently. Huh? But one insider information trade can make you rich instantly if you don't get caught, that is. This is obviously false. It's hogwash. If you had material non public information, that's the legal term for insider information, about a company, you could make a fortune overnight. But you could also go to jail. And some people do. Yeah. So I didn't really want to know anything. I don't like celebrities. I don't want to know anything about them. I'm not interested in car crashians or Brittany Lopez or Jennifer Spears or whatever. But Martha Stewart. I basically had to learn about Martha Stewart when she got caught up in this not material, non-public information, what we call insider information trade. She was the ex-girlfriend or boyfriend. Her ex-boyfriend was the CEO of a drug company, and he knew that the drug was going to be disapproved, was going to be denied by the FDA. So he sold his shares before the public information became public. The non-public information became public. Hey, folks, that's not right. That's illegal. When you are in that position, you are told by your lawyers and everybody else, don't trade on information that is not public yet. And he did. So he went to jail. His broker was the same broker as Martha Stewart's, who then told Martha Stewart, the broker said, "Hey, Sam is selling." His name was Sam. I don't think he's actually, said he knew what was going to happen, but it doesn't matter. It's illegal. And she got caught, and she went to jail. So don't do that, okay? So this is obviously false. The efficient market theory and the random walk theories are often also major proponents of index funds. They point to the fact that many professional money managers simply do not beat the market, especially during bull markets. From 63 to 98, the S&P 500 index outperformed general equity mutual funds 22 out of 36 times. And it's happened often. It's happened many long-term times when the average mutual fund did not beat the index. So they reason that you are better off accepting close to the market's return with low-cost index funds, since their theory tells them that no one can consistently beat the market. Well, why can't many pros beat the averages? Well, remember, the mutual fund is not free. The average doesn't have the market index, the market average doesn't have a fee attached to it. So many mutual funds have high annual operating expenses, and some have high turnover rates. And many mutual fund managements have very short time horizons. Consequently, many mutual fund managers have a very short lifespan. So think about it, folks. If you know going in that if you don't perform in the next 18 months, 2 years, you're out the door, you're going to be incentivized to take high risks. Well, great if it works out. If it doesn't work out, you've just lost a lot of money for your shareholders. So you see, many mutual fund companies now are giving their mutual fund managers more time, 4 years, 8 years to show that they can do a good job. And think about it. If you're a mutual fund manager, you've got to beat your annual operating expenses just to break even. So you already have one hand tied behind your back. And then if your company is one of the companies, there are fewer and fewer of them. This was Fidelity. This was Fidelity's motto. Basically, you're in, here, kid, here's $1 billion. See what you can do with it. And you got that other thing. You're not on the same side of the scrimmage line for you football fans as the investors in your mutual fund. That's why I'm sure I talked about it. One of the best signs of a long-term successful mutual fund is whether or not the managers have a lot of money, their own money in the fund. Right, they eat their own cooking. But the premises and the casual observations of the efficient market theory show them to be patently absurd. Patently absurd? Patently absurd. Many money managers have beaten the market over long periods of time. The more I practice, the better I get. The more lucky I am. Plus, if markets are efficient and rational, how do you explain manias, bubbles? People aren't rational. Occasionally, investors get caught up in what are called manias or bubbles. The internet bubble of the late 1990s was the latest stock mania. In my humble opinion, I mean, some of the companies in the last 10 years have really been some of the, internet related and other companies, disruptors. But the market as a whole is nowhere near as frothy, as they say, bubbly as it was in the late 90s. Before that, there was the Nifty 50 of the early 1970s. These were companies that you didn't have to worry about the valuations, the price to earnings ratios. There's no way they're ever going to go down. Xerox, Metro Media, Avon, what was it? No, I'm forgetting the name now. Calcomp and Tektronix. Who are they? Okay, so yeah, it didn't work out so well. We had that brutal bear market in 72 and 73. 73 and 74, I'm sorry, 73 and 74. The mania of the 1920s resulted in the crash of 1929. You ever hear of Radio Corporation of America? No, yes, you have. It's called RCA. You've heard it as the company's long gone, but the name is still around. And I forget exactly the numbers, but it lost about 90% of its value. In the 1840s, there were 400 railroad firms because railroads were the new technology. Steam engines, telegraph. There's less than 5 major railroad firms now. But the granddaddy of all manias, dear students, was the Dutch tulip bulb craze. You heard that right, tulip bulbs. Now, there's some controversy over how bad it really was, but it was bad. People lost fortunes trading tulip bulbs. Yes, you heard that right. Tulip bulbs. They actually came from Turkey, but when when you think of tulip bulbs now, you think of the Netherlands. But they actually didn't come from. They're not native to there, and they were the mania of the time. So there's a couple of books that are just a lot of fun to read, dear students. The Extraordinary Popular Delusions and the Madness of Crowds. It won't tell you why we're crazy, why we're irrational, but it sure will discuss some of the big irrational beliefs of the millennia, witchcraft, witch trials and witch hunts, and the Crusades. Now there was a real smart thing to do. So check it out. And then The Botany of Desire, a wonderful book. He's a very celebrated writer, Michael Pollan, and he shows that we like to think we're in charge of the plants. The plants are in charge of us. They get us to plant them, to feed them, to keep away their predators, and these humans are okay. Cool. It's a great book. And each time the phrase was, "It's a new era. It's different this time. The old ways of valuing stock are wrong." When you hear this, it's like, ooh, is it too late to get in? Each time they're wrong. So much for rational, efficient markets. We humans are not rational. Why do manias occur over and over again? Why haven't investors learned their lessons? Any ideas? What do you think? Well, this is Leonard Kaplan, president of the commodities brokerage firm Prospector Asset Management in Evanston, Illinois. And I just had this grab this quote. Market manias will happen over and over again because the public is infinitely stupid. Benjamin Graham says the speculative public is incorrigible. It will buy anything at any price if there seems to be some action in progress. It will fall for any company identified with franchising, computers, electronics, science, technology, or what have you, when the particular fashion is raging. The abuses are so largely the result of the public's own heedlessness and greed. Now, this was the last. He originally wrote the book in 1949, and then he had 4 editions, and this was the last edition. before he passed away, sadly, in 1975. And he was right on the money, folks. It was just right before a brutal bear market, 73 and 74. But, with different technology. If you replace franchising, computers, etc., with internet biotechnology, good old Ben could have been writing in 2000 instead of 1972. And what are the buzzwords today? Kleptocurrencies, meme stocks, NFTs. Are we in a mania bubble now? Many believe we are, certainly after some of the bubble has deflated in 2022, but we don't know how far down we're going to go. We don't know where if we're at the bottom. We don't know. I mean, that's you're trying to go forward, drive forward by looking through the rearview mirror. But it's true. They're going to happen. We know they're going to happen. We are not rational individuals. We are very irrational. How do most mania ends? Well, yep, you guessed it. They invariably end with a crash, a panic, a downturn, a bear market, whatever you want to call it. The bigger the party, the bigger the hangover. They are not fun, but the odds are you will live through at least one, probably two or more through your investing career, especially you very young folks. And this was said back in 1999. Now, some of you weren't even born yet, but it was very heavy days. Companies were going public and becoming instant billion-dollar companies, and they didn't have any earnings, and they probably wouldn't have any earnings for at least 4 or 5 or 10 years. With this many strong years, I have the concern that there are a vast majority of companies that are significantly overvalued on a long-term basis. Now, who said this? John Lovelace, who was the son of the gentleman Jonathan Bell Lovelace, who started the American Funds, Capital Group. And he was very responsible for taking it to the next level. He took over late 50s, early 60s, and then ran it until 2000 when he retired. 50 years of experience, folks. People thought he was nuts, right? How dare you say, we're all going to get rich, rich, rich. Mr. Lovelace was right on the money, and he retired just at the right time. Oh, by the way, the 2008 and 2009 market crash was not caused by a stock market bubble. It was a real estate bubble and the mortgage-backed bonds that were tied to the real estate mortgages. So we'll discuss that later on. So now let's take a look at a history of bear markets. There's also another commentary on the website and in Canvas. But what you notice when you scan through these is that some are brutal, some are not so bad, some last a long time, some don't last a long time. There's no typical bear market. All we know is that they're going to happen. That's all we know. And look, the brutal Great Depression was an 88% decline. Ouch. And it lasted 25 years. My goodness. But then some last a couple of months and others last a couple of years. And I think the average is about 13, 14 months. So we know they're going to happen. And by the way, the January 2022 peak has been eclipsed. So the January 2022 bear market has now ended as of January 2024. And you'll notice that sometimes the PEs decline quite a bit, the price to earnings ratios, sometimes they don't. But the important thing is we always have come back. And we always will. Well, as you've heard me say before, it's not guaranteed. And if it does all fall into a pool of tears, crack and dissolve, technologically based civilization just has failed. You know, your stock portfolio, your Roth IRA, whatever stocks are in your Roth IRA or whatever mutual funds are in your 401k, they're going to be the last things that you're going to be worried about. You're going to be worried about digging for beetle grubs and boiling bark for dinner. But I'm very optimistic, as I've told you. I'm very optimistic, assuming we don't blow ourselves up, die in our own ways, some huge meteorite comes crashing down, earthquake destroys half of the Western continent. Those things could happen, but last 200 years, the news has been very, very good. Yeah. And the very cool thing about bear markets, the very great thing about bear markets is that they give us an opportunity to buy companies at bargain prices. It was in chapter 3, but there's a little discussion from Benjamin Graham's book, A Random Walk, The Intelligent Investor, that shows that we want these things to happen. But again, we're not rational beings, because here, this is one of my favorite things to show people who are really worried. This is what buying low feels like. Yeah, right. He's eating all the good stuff and now broccoli and lima beans. Ugh. Everyone knows the adage, buy low, sell high, but very few people follow it. Why? Because for most investors, nothing feels worse than a market decline. And I got to tell you, folks, it does. People tell me this, and I feel it too. When the market's falling like a stone, it feels like someone has kicked you in the gut and the stomach, or punched you in the stomach. But that's when history tells us that's the time to step up and buy. And people like Warren Buffett have done that in the past. We'll talk about him in the next presentation when we get to All Stars of Investing. So when people ask me, is there going to be a market crash? I say, yeah, there's going to be. What do we do? What do we do? Nothing. You're asking me when it's going to happen? I don't know when it's going to happen. You're going to ask me what to do? You sit tight. Now, assuming you have a long-term perspective. If you need this money in the short term, right, I think you should have that in your arsenal now. If you need money in the short term, where should it be? Savings accounts, money market, mutual funds, CDs, treasury bills. But if it's 5, 10, 20, 30 years from now, you're not going to touch this money. Yeah, I know. It's nothing's perfect, right? I wish I could tell you you're going to buy stocks and they're never going to go down, but I'd be lying to you. And if anybody does tell you that, as we said back in chapter 1, they're lying. Now let's take a look at the 13 worst days of the Dow Jones Industrial Average. And what you will notice, ignore the points, because that's not important, because the numbers are different depending what time of the century it is. Look at the percentage declines. October 19th, 1987, the worst day market downturn. Black Monday, it's called. Look, folks, I don't know when it's going to happen again, but it's going to happen again. Maybe it might take a few days, a week or so. 2008, it went down 22% in 1 week. Other times it's gone down that in 1 month. It's going to happen. But what's really interesting about these days of when they happened, what we should first do is get rid of March 2020, because that was COVID. And that was, totally something completely out of the blue, right? And if you do that, what happens, you're left with 11. And then what you find is that 6 of them are in October. 1, 2, 3, 4, 5, 6. And 1 is in early November. So 7 out of 11 days are at the exact same time of the year. Now, you might think that's a coincidence, and you might be right, because no one's actually ever come up with a theory, a reason for why this happened that can be proved. My belief, and there's no way to prove this, is that as we've seen, we're not rational individuals. And then we'll see that again in our next presentation with investor psychology. There's a reason why All Souls Day, All Saints Day, Halloween, Day of the Dead are all at the end of October, beginning of November. Because 1,000 years ago, 10,000 years ago, 100,000 years ago, We saw the fall. It's a reason why we call it the fall. The plants are dying. The sun's rays are getting weaker and weaker. There's less daylight. And we all looked around at one another and realized that a lot of us aren't going to make it through the winter. Exactly. We're as much as in the modern world we believe we have control over nature. Well, you know what? We're still animals, and we're still, we're still that still affects us. That fall, and so I think personally that's the reason why the worst months of the year are September, October. And then from November to March tend to be the best days, the best months of the year. So, there's no way to prove it, but it's my story and I'm sticking with it. But realize there's going to be bad days, folks. And again, we can turn them to our advantage if we don't panic. And we have some cash on the sidelines. We have some companies that we've thought about buying, but we thought they may be a little too expensive. Or if we're just putting $50 or $100 a month or whatever into a mutual fund, we just say to ourselves, well, next month we're going to get better bargains. And we don't worry about if now is a good time to invest or now is a good time to run for the exits. But when you hear when you see everybody running for the exit, right, right, exactly. Cool. Okay, now, thank you so much for being in our class. We're so proud of you. Think of how much you learned. In our next presentation, we'll take a look at investor psychology, some common investor weaknesses, revisit the active versus passive management arguments, and then finally look at some of the all-stars of investing. Because I always think if you're going to learn something, learn from the best. And it doesn't necessarily mean you're going to be the best, but at least you can learn from them and not make the same mistakes that a lot of people do who don't do the education, the research, the thirst for knowledge that you, dear students, are doing. We're so proud of you. See you on our next presentation.